Imagine you have only $1,000. You see two people. The first person invests his own $1,000. The second person borrows $9,000 and invests a total of $10,000. If the investment goes up 20%, the first person makes $200, but the second person makes $2,000. Sounds amazing, right? Now imagine the investment falls 20%. The first person loses $200. The second person loses $2,000. This is the power of leverage. The same tool that can build massive wealth can also destroy years of savings in a matter of days. Today, we will completely understand leverage, how rich people use it, why beginners misuse it, the dangers, the benefits, real-life examples, and how to use leverage safely. By the end of this video, you'll understand why leverage is often called a double-edged sword. Leverage means using borrowed money to increase the size of your investment. Think of leverage like a machine. It allows you to move something much bigger than what you could move using your own strength. In finance, leverage allows you to control a larger asset with a smaller amount of money. Simple example, you have $10,000. Without leverage, you can buy $10,000 worth of assets. With 5x leverage, you can control $50,000 worth of assets. Your gains become larger, but your losses also become larger. This is the most important thing to remember. Leverage magnifies everything, not only profits, losses too. Many people ask, if leverage is dangerous, why does it exist? The answer is simple, because leverage helps businesses and investors grow faster. Example, suppose a company wants to build a new factory. The factory costs $100 million. The company has only $40 million. Instead of waiting years to save the remaining money, it borrows $60 million. Now it can start producing products immediately. If the factory generates more profit than the loan cost, the company benefits. This is productive leverage. The world's biggest companies use leverage. Banks use leverage. Governments use leverage. Real estate investors use leverage. The problem isn't leverage itself. The problem is using it incorrectly. 1. Debt leverage. This is borrowing money from a bank. Example, home loans, business loans, car loans. 2. Investment leverage. Using borrowed money to buy stocks, ETFs, or other investments. Margin accounts are common examples. 3. Real estate leverage. This is one of the most common forms. Example, you buy a $100,000 property. You only pay $20,000. The bank provides the remaining $80,000. You control a large asset using a small amount of your own money. 4. Trading leverage. Used in Forex, crypto, futures. This is often the most dangerous type. Many traders use 10x leverage, 20x leverage, 50x leverage, 100x leverage. Even a small market move can wipe out their accounts. Let's see how leverage can help. Example, you buy a house worth $100,000. You pay only $20,000. The bank finances the rest. 5 years later, the property value becomes $150,000. The increase is $50,000. Without leverage, if you invested $20,000 directly, and it became $30,000, profit is $10,000. With leverage, your original investment was $20,000. Your gain becomes approximately $50,000. This dramatically increases returns. This is why many wealthy people use leverage in real estate. Not because they love debt, but because leverage increases return on capital. Now let's discuss the dangerous side. Example, you buy the same property. Instead of increasing in value, it falls. The value drops from $100,000 to $80,000. Your equity can disappear quickly. This is exactly what happens in market crashes. Leverage doesn't care whether the market rises or falls. It magnifies both. Main problems. Problem 1. Bigger losses. A 10% decline can become a huge loss. Problem 2. Emotional stress. People become fearful. They panic. They make bad decisions. Problem 3. Forced selling. When debt payments become difficult, investors may be forced to sell. Problem 4. Bankruptcy risk. Too much leverage can completely destroy wealth. A margin call is one of the biggest dangers. Suppose you invest $10,000. You borrow another $40,000. Total investment equals $50,000. The market falls sharply. Your broker notices your account value is too low. The broker demands more money. This is called a margin call. If you cannot provide money, the broker sells your investments automatically. Many investors lose money this way, especially during market crashes. The 2008 financial crisis, one of the biggest examples. Banks used enormous leverage. When housing prices fell, losses multiplied. Many financial institutions collapsed. This led to the global financial crisis. Global financial crisis. Long-term capital management. A famous hedge fund used excessive leverage. It employed brilliant economists and mathematicians, but leverage amplified losses. The fund nearly collapsed. This shows that intelligence alone cannot protect investors from excessive leverage. Most beginners use leverage for consumption. Examples: expensive cars, luxury items, unnecessary purchases. Wealthy investors often use leverage for productive assets. Examples: businesses, rental properties, cash flow producing investments. The difference is simple. Poor debt buys liabilities. Good debt buys assets. A liability takes money from your pocket. An asset puts money into your pocket. Rule 1. Never use leverage without understanding risk. Rule 2. Avoid high leverage, especially 50x, 100x. These levels are extremely dangerous. Rule 3. Always have an emergency fund. Rule 4. Use leverage only for quality assets. Rule 5. Never invest borrowed money in something you don't understand. Rule 6. Stress test your investments. Ask, what happens if prices fall 30%? Rule 7. Avoid emotional decisions. Leverage punishes emotional investors. Should you use leverage? The answer depends on your situation. For complete beginners, usually no. First learn saving, budgeting, investing, then study leverage. For experienced investors, small, carefully managed leverage may help improve returns, but only when risks are fully understood.